Good afternoon, everybody, and welcome to our webinar this lunchtime entitled Changes to UK Small Company Accounts. My name's Alex Peel. I'm Head of Audit Assurance at James Cooper Creston, and I'm joined today by my colleague John Bailey, who is a Director in our Audit and Assurance team. Today we're going to cover a number of points relating to accounting for small companies, and we're going to focus on small companies today. So we're not going to cover the requirements of medium or large companies specifically. However, there are a number of changes. What we're going to focus on is changes to the accounting requirements in terms of the financial reporting requirements. So we're not going to necessarily look at the changes to how you might calculate the numbers in the accounts. We're going to look at the actual accounts themselves and, for example, what has to be filed. So we're going to take a look at a bit of background. We're going to look at an EU Accounting Directive. Hopefully not spend too much time on that. We're going to look at a summary of the key accounting changes for small companies and changes to the accounts formats, as I mentioned, and also then look at differences in the Companies House filing options. Now, as a few of you may know from previous webinars that you've attended, we do like to try and make these a little bit interactive. So we've got a couple of questions for you today, hopefully not going to challenge you too much, but you should see the first of those questions on your screen now. And the first of those is, if you qualify as a small company, do you currently file abbreviated accounts at Companies House? So if you can vote now, votes are coming in there, and then give it 3-4 more seconds before we close that. Thank you very much. So we'll close that poll there, and the result of that, and part of the reason for doing that is just to help us to know who we're talking to today. So 90% of people who are on the webinar at the moment actually do file abbreviated accounts at Companies House, and then there's a couple of people who don't and a couple of don't knows, and you'll see why that's relevant in a minute. Okay, so a bit of background, as I said, the future for small companies, and actually this really covers the future for all companies, but as you'll know, again, if you've been on previous webinars, there's been a number of changes to accounting for companies over the last few years. This new framework was outlined in something called FRS 100, or Financial Reporting Standard 100, a few years ago now, and then further detail on the actual accounting is in FRS 101 and FRS 102. So that's Financial Reporting Standard 101 and Financial Reporting Standard 102. The thing that is most relevant to small companies applying the Financial Reporting Standard 102 is Section 1A of that standard, which outlines the small company requirements. There's something else called FRS 105, which you may well have heard of, which applies to a category of companies called micro-entities. And the point really to note is that all other UK GAAP or all other UK accounting standards are superseded by this. Okay, so FRS 102 was and is a fundamental rewrite of UK GAAP. One of the key reasons for doing it really was to align ourselves more with IFRS, or International Financial Reporting Standards, but as it happens, there are still some significant differences. As I mentioned, it replaces all UK GAAP for all medium and large entities unless they choose to use IFRS, but it also impacts most small companies, albeit, as I mentioned, there are special rules in Section 1A, and again, as I said, micro-organisations can use FRS 105. Okay, so as I said, we won't spend a long time talking about EU directives. However, part of the changes and part of the reasons for talking about changes to accounts formats come from the recent EU Accounting Directive, which was implemented in the UK in 2015. This does a number of things. you might be interested to see the increases in small company size limits. So previously, for example, turnover limit was £6.5 million. That went up to £10.2 million. The gross asset limit went up from around £3 million up to £5.1 million, and as ever, the number of employees stays the same. So this has obviously meant that there are far more small companies than there ever used to be. It's also meant that more companies are exempt from audit, because now most small companies are able to take that exemption. And it's applicable to accounting periods beginning on or after the 1st of January 2016. And as we'll go on to discover, there's various amended accounts disclosures as a result of this, and different filing obligations for small companies. So when do we need to be worried about this? FRS 102 applies for accounting periods, as I mentioned, beginning on or after the 1st of January 2016. Medium and large companies were effective the year before that. Small companies got a grace period, and we put some common year ends in the table below. So, for example, with a company with 31st of December year end, presuming they're doing a 12-month accounting period, their first period affected will be 31st of December 2016. March year-end companies, obviously March 2017, and September year-end companies, 30th of September 2017. There's another column there which we'll probably come on to later on, something called your transition date. And the transition date, all that is, it's the opening day of the comparative accounting period. And the reason why that's relevant is because if you do have changes to the numbers in your accounts, you have to go back to that transition date and initially convert your balance sheet as at that date effectively. Okay, I'm now going to hand over to John, who's going to go through more of the changes.
Thanks, Alex. So we're just going to start off with a brief overview of how you might be affected by the introduction of FRS 102. As Alex has alluded to, there are some significant differences to the existing small company accounting standards. Some of these changes could result in a change to the profits that you've been reporting in previous years and those that you report in the current year. Consequently, that could have a knock-on impact on the amount of tax you're going to pay. If you've got things like bank covenants that say you must have certain asset levels, may have impacts on those. And also the ability for some companies to pay dividends, especially when small companies have taken a lot of their remuneration out in dividends in previous years. But the main thing really we're going to focus on today is the changes to the format and some of the content of the accounts. We thought it would be very helpful just to summarise some of the key accounting changes that have occurred for small companies. So those of you that have watched our previous webinars will know some of these in more detail. So there have been various changes, including changes to the way we account for financial instruments, specifically complex financial instruments such as forward exchange, forward contracts. Previously there was no requirement for a small company to account for share options. Now those companies will need to account for those through their profit and loss account, only for share options that they've issued since what Alex referred to as their transition date. In some instances, small companies will have had loans from shareholders and directors that are repayable in more than 1 year and charge no interest. There are certain accounting adjustments that need to now be made to take account of those non-market loans. Previously, there was no requirement for companies, small companies, to accrue for holiday pay that employees had earned but not taken. That changes and an accrual now needs to be made. And then there have been some changes to the way that investment property is accounted for, specifically the accounting for the deferred taxation elements of that. So that's really all I wanted to say on the accounting changes. Alex has previously said that there are some disclosure exemptions available for small companies in preparing their financial statements. And if we focus first on a full set of shareholder accounts. There's no requirement for a small company to present a cash flow statement. That's not really a change from the previous regime, though. No requirement to show a statement of changes in equity unless the shareholders think it's required to show a true and fair view, although interestingly some of the accounting bodies are suggesting that people should put that in. No strategic report is required. Companies have the ability to prepare what is known as an abridged set of accounts and also file what is called a filleted set of accounts. We'll come on to those shortly. There are also a limited number of mandatory disclosures, and these are required by EU law, and specifically the EU Accounting Directive Alex referred to. Some of these will greatly add to accounts, some of them will not, and a lot of them will not be that relevant. We'll come on to those. There's an overriding requirement still for a need to prepare accounts that present a true and fair view of the entity, and that's something specifically that FRS 102 Section 1A encourages, and that also encourages users to consider the inclusion of relevant disclosures where FRS 102 says that a disclosure is relevant to that entity. So I think what they're trying to say there is if the directors or shareholders think that something is very important to the accounts, that should also be put into the accounts. So if we just talk firstly about these mandatory disclosures that all small companies must now do. First one is accounting policies. That is exactly the same as the old small company regime. Fixed asset movements, no change there. Details of revalued fixed assets, no changes again there. Financial instruments and other assets measured at fair value, for example, forward exchange contracts, which people are now having to account for, disclosure required of those. Financial commitments, guarantees or contingencies need to be disclosed, so details of commitments entered into before the year end. For example, if there was someone building a building and they had entered into a large capital commitment before the year end, that would need to be disclosed. Previously, you wouldn't have certainly needed to disclose that in your abbreviated or small company accounts filed at Companies House. Details of security given on loans that amount due after 5 years. Average number of employees. Previously, for small companies, there was no need to say anything about the average number of employees, let alone disclose them in your accounts you're going to file. Details of advances, credits and guarantees given to directors. So where you have things like overdrawn directors' loan accounts, it's mandatory to disclose the amounts owed by the directors at the year end. And that's not really a change from the old filing regime. Just carrying on with these mandatory disclosures, now a mandatory requirement to disclose related party transactions, and specifically those where they've not been on market terms. So these could be loans from directors given to the company at a very low or no interest rate. Where a small company is a member of a group, there's a requirement now to show the name and registered office of a company that is higher up in the group that is preparing group accounts. So that will only impact obviously on people where consolidated financial statements are prepared. Anything that is considered to be of exceptional size or incident needs to be disclosed in these notes. So if, for example, there was a very large loan write-off or an impairment of a property, then there may be a requirement to show that if the directors for it was required to show a true and fair view. And finally, any details of any off-balance sheet arrangements or any post-balance sheet events need to be disclosed. You would never have needed to disclose those in a previous small set of company accounts. So moving on to filing accounts at Companies House. Now 90% of you said previously that you filed abbreviated accounts. For periods beginning on or after the 1st of January 2016, you can no longer file those abbreviated accounts. So in a set of abbreviated accounts, you will know only the balance sheet, certain accounting policies, and then selected notes would need to be filed. Typically, I would say a set of abbreviated accounts would run to about 5 pages maximum and would give very little information about a company, you wouldn't be able to tell what their turnover was, what their profit was, or anything really about them. So we've really moved on to now what the ICAW are referring to as a file what you prepare model. So the idea being that if you put something into your full company accounts, you must then file that at Companies House unless there is an exemption from filing that. And we'll move on to some of those exemptions when we talk about filleted accounts in a minute. The filleted accounts basically give you the option to remove your profit and loss account and any related notes that relate solely to that profit and loss account. Also give the option to remove your director's report and various other things, and we'll touch on those again very shortly. All of the balance sheet notes that you include in your full set of accounts must be filed in what are known as your filleted accounts at Companies House, unless you choose to prepare what is known as an abridged set of accounts, and we're going to talk about those very shortly. So I think really what this change from filing abbreviated accounts to filing filleted accounts will mean is that in some places there will be significantly more information filed at Companies House. So if we now just move on to, hopefully everyone can still see our screen and it hasn't gone too haywire. Looks like we're back with you now. So if we just move quickly on to the abridged accounts. So what these abridged accounts basically allow a company to do is to prepare a set of accounts with very limited information in it. Now, if you prepare a set of accounts normally, you would show a balance sheet that would show tangible assets, debtors, creditors, stock, with breakdowns in notes of those various different items. So for example, with debtors, you would then show a note that would break down and show you the split between trade debtors, other debtors, amounts owed by group. If you decide to prepare one of these abridged set of accounts, it will then remove those related notes. And what you'll be left with is a sort of very minimalist set of accounts to file at Companies House. Other differences in these set of accounts as opposed to a full set of accounts are that the profit and loss account will start at gross profit rather than showing turnover. When you then come to file these abridged accounts at Companies House, you have the same sort of filing reductions as you do with the filleted accounts. You can remove the director's report, you can remove the profit and loss account. And what you'll be left with is probably going to be reasonably close to a set of the old abbreviated accounts, depending on whether you still have any of the sort of mandatory notes, such as post-balance sheet events. One of the key things to say about preparing these bridged accounts is that every single member or every single shareholder of that company must consent in writing to the company preparing these bridged accounts, and that needs to be done every year for the preceding financial year. So where you have a personal service company or a small number of shareholders in an owner managed business, that shouldn't be too difficult. Where you have a larger number of shareholders, for example, maybe in a startup business, it might be more difficult to get that shareholder consent. And some of the shareholders might not be so keen on getting such a reduced set of accounts. The final thing really to say on the abridged accounts is that there's still an overriding requirement for those accounts to show a true and fair view, and that really is going to be at the options of the directors to decide that. So I'm just going to hand you back to Alex, who's just going to summarise for us.
Okay, thank you very much, John. Before we sort of conclude, I'm going to put up another poll. The question is, do you think that the level of information publicly available from small companies' accounts filed at Companies House is going to either increase, decrease, stay the same, or don't know? So please do vote on that, and we'll give you sort of 10 seconds to do that before we move on. So the votes are coming in there. I think most of you have now voted. So 2 or 3 more seconds and then we'll close that down now. So that's quite interesting actually, quite a mixed response there. It's actually quite equally divided between 35% of you think it'll increase, 22% decrease and 35% stay the same, and then 9% don't know. So that's quite interesting. So I should have said at the start that we do have a little bit of time for some questions before we conclude. So if you do want to ask a question, then there should be the facility on your screen to ask that. But in summary, really, it is complicated. I think we've gone from a situation that's really stayed the same for many years, where small companies have largely used the financial reporting standard for small entities and various Companies Act disclosure exemptions, and that has enabled them to prepare a very straightforward set of full accounts for shareholders and an abbreviated set of accounts to send to Companies House. We've now gone from that situation, which everybody has known about for a number of years, to a situation where there are quite a number of different options. Even where you've got a set of filleted accounts, for example, you still have a lot of options in what you can do with those accounts. So it's not as simple as it was in the past. More companies are qualifying as small, which in a way is going to be a good thing for those which were medium-sized and now fall into the small company regime. So they're going to be more small companies. And as we've mentioned, there are some key accounting changes versus the existing FRISI, or the FRISI that previously existed. We have done other webinars on that topic which are available on our website. So if you are interested in more how the numbers are calculated and want to know whether your accounts are going to change in terms of the numbers presented, then do have a look at those webinars, or of course get in contact with us. Okay, so I think that is pretty much it in terms of what we wanted to cover today. Of course, if you do have a question, then please do contact either myself or John, or of course your usual contacts at James Cooper. But we do have a little bit of time, so if you do have a question, then feel free to ask it. We do have a couple of questions coming in. The first of which is, you mentioned microentity accounting and FRS 105, and can you explain what a microentity is? So a microentity is a company which is smaller than a small company in a way. There are separate size requirements for microentities, and broadly speaking, if you are within 2 of the 3 limits which I'll mention, then you should be able to qualify as a microentity. And the limits relevant for those entities are turnover of £632,000, gross assets of £316,000, and 10 employees. So if you are a company which is smaller than that, so you might have £500,000 worth of turnover and only 5 employees, for example, then you could consider microentity accounts. And again, I think we've got another webinar available on microentity accounting which you can have a look at. There's another question that has come in. It's just about filleted accounts and whether the directors do need to approve those accounts. So on those accounts, it depends really how you file them. If you file online, obviously you will file without signatures on them. If you file a paper format, then you need to include a director's signature on the balance sheet. However, there's no formal requirement to actually approve the accounts. However, I think in practice, you'll probably want to have a look at them because it's going to determine what's on the public record, and whilst you might not formally minute a board meeting that says you've approved them, I think the directors are going to want to consider what goes into those accounts. Got a couple of other questions. I think we've still got a bit of time before we finish. A question, and it's a very good question actually, because it is confusing. What is the difference between filleted accounts and abridged accounts? And I'm going to pass over to John to take that question.
Yeah, okay, thanks. I think the main difference really between the filleted accounts and the abridged accounts is the amount of information that you are giving in the notes. I suppose it's important to say first that a set of filleted accounts is the sort of filing copy of the full accounts that you're going to send to Companies House, whereas a set of abridged accounts is a set that's going to go to the shareholders. Now, there is an option to then do an abridged filleted set, which you would then send to Companies House, and you can see how confusing it is getting. But the main difference between the filleted and the abridged accounts is the notes that you would put in for the balance sheet. So in the filleted accounts, you would still need to have things like the breakdown of debtors and a breakdown of creditors, whereas in a set of abridged accounts, you're not going to have that breakdown of debtors and creditors. But I think it would be useful to pick that up with you offline as well. So there's a second question that's come in as well, saying that on the abridged account slides, it showed that the P&L can start at gross profit, but then said that the P&L can be eliminated. Can we please clarify at this point? So I think that comes down to the fact that then the abridged accounts that you prepare will have a profit and loss account and will have a director's report, and that profit and loss account will start at gross profit rather than turnover. But then when you go to file those abridged accounts at Companies House, you will then file a set of abridged filleted accounts, and that will remove the P&L in the same way as it would in the full accounts. So I think there's really sort of two sets of accounts there. Hopefully that clarifies your question.
Okay, thanks, John. I think that's unfortunately all we've got time for today. If you do have further questions, then do get in touch with either one of us or your usual contact at James Cooper Creston. Thank you very much for listening, and just to say that the webinar will be available on our website. So if you want to listen to it again or pass it to somebody else to listen to, then please do so. Thank you very much for your time.